Hello, I'm Adam Shapiro. And while the April tax deadline might seem far away, it is never too early to start thinking about ways you can save some cash and start noting those deductions. David Selig, a federal tax practitioner with Selig & Associates, as well as founder of True Tax Help, is here with 5 tax-saving tips that you can use. And we're going to go through these with you, David. Thank you for joining us and welcome.
Thanks for having me.
Let's start with this one, because a lot of people are going to have barbecues this 4th of July throughout the summer. Could you actually figure out a way to make the cost of that barbecue a tax deduction, especially if you're spending $250, $300 on a whole family bash?
Sure, as long as there's a legitimate business purpose. Remember, I think it was Ghostbusters, where that accountant had a party, but he invited his clients over? There's a lot of truth to that. So if you have a legitimate business purpose and you're socializing, a piece of that can be deducted. The rules can be found in IRS publication 463. Makes for some good light reading.
Yeah, I bet. Okay, but very quickly, let's say you spend $300 on a barbecue. If you qualified, what portion of that would be deductible?
That really depends on the amount of business, the amount of people they are. It can't be a sham transaction.
All right.
That's what the IRS will look for. If you have one client and you just sort of gloss over, you can't write it off.
Okay, so you got to be careful on that one. What about parents who send, and this is happening a lot, parents sending their kids off to summer camp? In some cases, tuition for summer camp for 8 weeks of the summer can be as high as $8,000, $10,000. That's deductible?
Yeah, also in part. Now, there's certain rules, income and such, that apply, so you can't just necessarily write off the entire thing. Again, if your viewing audience wants to look, publication 503 is very clear on that, and if you're entitled to a deduction, take it.
Okay, so, but let's use the $10,000 example. I'd assume the income of people who can afford to send a child away for 8 weeks for $10,000, nothing's going to be deductible out of that 10.
Well, you know, again,
it's income-based, right?
I think you have to look at the actual facts and what their adjusted gross income is.
Okay.
Because the gross and the adjusted can be a world apart.
All right, let's move on. A lot of people putting solar panels on their homes. I grew up in a place where we had solar panel that heated our water.
Right.
Is that tax deductible?
Yeah, there are energy credits, and also keep very good records, because when you make a capital improvement to your house, that increases the basis. So when you sell the home, the money that you put in with after-tax dollars will be exempt from taxation.
Don't you carry that, though, until the last time you sell, or every time you sell, is that then deductible?
No. When you sell your home, let's say you're a married individual, and your first $500,000 of profit would be tax exempt. Now, the thing is, some of these houses improve mightily. So it's not just the $500,000, it's the purchase price plus the gain. Now, the purchase price, if you make capital improvements, will include those costs.
So the goal is, 1, make sure that your equity grows to above $500,000 when you sell. If you're past the $500,000, then the receipts for having it painted and having it fixed up, maybe redecorating, that's what you use to deduct so that you can maximize your capital gain.
The capital improvements,
Gotcha.
really. Right.
Okay. What about the fact that storm damage losses are deductible? How does that work?
Okay. A lot of people were really ravaged the past couple of years here, and the Internal Revenue Service realized a lot of people are in trouble, particularly if you are in a federal disaster area. The IRS has a publication, 547, for that, storm damage, that can be written off. I believe the first $100 you're on the hook for, and then the rest. However, if you are reimbursed by the insurance company at a later date, that money then is taxable, because you've already written off the damage.
Okay, so let me break that down.
Sure.
If insurance is going to cover your damage, then don't bother with the deduction. Or do you have to, let's say you had $50,000 of damage, Hurricane Sandy kind of thing. Is the $50,000 that the insurance company uses to repair your house, do you pay taxes on that?
Well, no, you wouldn't unless you wrote off the damage. You see, not everybody...
If you wrote off the damage, got it.
Not everybody was able to receive that money in the year. You know, if you look at what happened with Sandy, the adjusters were working overtime, but a lot of people are still waiting for their claims to be paid. So the government allowed them to write off their expenses in real time, and that was a big help.
Do you have to be in a federal disaster zone, or could it be like a very bad thunderstorm that comes through and does roof damage?
Again, you should really look at the publication, the federal disaster zone. They'll give you a carte blanche. If you just have really bad damage, there are some strict rules that apply.
And then final charitable donations. This is throughout the year, but in the summer people are cleaning out the garage,
Absolutely.
that kind of thing.
Great time. Put all your things together, get your house in order, whatever you want to donate, make a nice list, take a photograph in case you get audited, and make sure the charitable organization is a real charitable organization.
And acknowledges the amount.
Right, in writing, the whole Megillah.
All right, so make sure you get the receipts. I know Housing Works here in New York City, they have a whole sheet that tells you, that shirt's really only worth $1.
Ooh.
That kind of thing, but maybe that dresser was worth $25.
Right.
Might have paid $500. All right, David, thank you very much for joining us. For more tax-saving tips, check out David's website, truetaxhelp.com. Thanks for watching.